diagram, you can see I'm involved in lots of different areas, and that's just so I keep that diversification and all the assets are somewhat uncorrelated. Hello everyone, and welcome back to Strategic Trading. Today I want to go over asset correlation and how it can protect you, but also reduce your risk on your portfolio. Now, I'm going to go through strategy diversification and portfolio diversification, the two things we went over the past couple of weeks, and I want to show you how you can apply asset correlation to both of these structures. I think there'll be a lot of value gained from watching this episode, as it's something we do ourselves and has helped us massively even through difficult times. So first of all, let's go over what asset correlation is. Some of you may be aware of it, but we'll just jump into the general simple theory behind it. Asset correlation is just a simple measurement of how assets move or investments move against one another. So to give you an example of positive correlation, let's say we're looking at the stock market. We're looking at the S&P, it's moving up nicely, but we're also looking at the German DAX, it's moving up nicely. They're both moving up at the same time, meaning that they've got a positive correlation, meaning when one moves up, the other tends to. Now let's flip that scenario around. Say we are looking at the S&P again. It's going down. But we're also looking at the price of oil. It's moving up. So the S&P is moving down while the oil is moving up. That would have a negative correlation because when one's moving to the downside, the other is moving to the upside. So we'll jump into more about that later on, but that's just the general theory. So the mission for us is we need to find and build a portfolio that is uncorrelated. So how can we achieve this? Well, we can achieve this by looking at different markets, how they move, and putting them together in a bigger portfolio. So we'll jump through different things that you can look at to build that uncorrelated portfolio. And the goal of an uncorrelated portfolio is just to get a steady increase in returns while reducing the risk to the downside. So what I mean by that is exactly the example I gave with the S&P and oil. When one's going down, we want the other to go up so that when one does go down, it's neglected and cancelled out by the other one going up. This is so crucial, especially in times where there are financial crashes. And yeah, it just means that you're keeping a little bit more of your wealth and it's not eating in and you're not overexposed in one type of market. So first of all, let's go into asset correlation within a strategy. Now, there are multiple ways we can go about this, but let's start with the most basic point, trading different pairs. Now, this might sound obvious to some people, but some people are religious to one pair. And I'm not saying that it's wrong, because many traders have had a lot of success by only trading one pair. But expanding your strategy into other pairs that are also profitable is a good first step. So the next part we would do is once we find profitable results trading other pairs, we will then check to see if these pairs are heavily correlated. Now you can do this by visiting a simple website like myfxbook.com and check the different pairs against each other to see if they've got positive or negative correlation or zero correlation whatsoever. Another way you can go is trading different markets that are uncorrelated. Now, this could be things such as like energies like oil or indices like the S&P or the German DAX to really spread out the strategy into other areas. Putting these two together will really help your results. But the other thing that we can also do on top of this to make it even more uncorrelated is we can look at trading different strategies. Now, these could be mean reversion, breakouts, or even reversal strategies. Applying the same theory as I just previously stated, if we get these uncorrelated assets with these uncorrelated strategies, it's only going to increase the likelihood of success for a long-term portfolio that are uncorrelated, meaning that when one's not working, the other might be working. So it neglects the downside potential. And lastly, if you are trading multiple strategies with different asset classes, one way to make sure that nothing ever like burns and falls is to keep the risk low. If we keep the risk low, it allows the probabilities to play out and the profitable strategies will play out, and it will only increase the likelihood of your success. Now let's look at asset correlation within a portfolio. There are many ways that you can diversify, but most choose to invest in the stock market. And you'll see a lot of people preaching about the S&P 500, and they'll say that that's where you should invest your money. Now, the S&P 500 has a great historical return, but it does have some periods where it hits severe drawdown or stagnation periods, especially when the world enters deep recessions. It's never good, and you'll never really see too much growth within these periods. Now, if you look back to the historics, sometimes the S&P can take between 5 and 10 years before all-time highs are broke. So yes, having the S&P is good to have as a portfolio, but it's also beneficial to add other areas in. Now, the first one being learning to trade or renting a system that works. Doing one of these will be a great addition to your portfolio because, unlike the stock market, when you trade, you do it differently. So it is very uncorrelated. Another option is crypto. Now, this is high risk, high reward. Lots of people have made fortunes from it, but lots of people have lost fortunes from it. So it's good to have a small portion where you can dabble in these sort of things just to expose yourself in case you do catch one of these kind of big runners. Now, the last option I'll cover is a very solid option and has made more millionaires than any other of the areas, and that is real estate. Real estate has been booming for about a decade until the interest rates recently went through the roof. But it's still a great option to get involved with. The only downside is the cost to getting started can be high, but there are other areas that you can get involved within the markets and within real estate, and that is through REITs. REITs are just a real estate investment trust, and you invest money into them, they manage the properties or buy the properties, and in return, they will pay you dividends. Now, there are other assets out there that you can invest in to make a bigger portfolio, but I just wanted to mention 4 completely different ones that, putting these 4 together, could create a great uncorrelated portfolio. So let's take a look at what roughly my portfolio looks like. From the diagram, you can see I'm involved in lots of different areas, and that's just so I keep that diversification and all the assets are somewhat uncorrelated. So we'll just quickly break it down. First of all, I've got about 20% in my ISA. Now, this is just simply an investment account that is an option for me in the UK, and within it, I diversify into lots of different areas itself. For example, because I'm more interested in trading, within my ISA, I don't like spending too much time looking at stocks, so majority of my portfolio within my ISA is in mutual funds, ETFs, so then I don't have to actively manage them. Somebody else does for a small fee. Next, I allocate 30% of my portfolio to our own algorithm, Sequenti. This is because the system itself is low risk with a high reward and can perform well when there's momentum in the markets, and is not affected when there's like market crashes in the stock market and everything like that. Now, you yourself can use this algorithm as well to add that asset diversification to your portfolio. All you need to do is just click the link in the description and you'll be taken to an EA assessment tool where it will score you and produce you with an answer whether you're the right fit for the algorithm. Now, the next category I invest in is crypto. Now, I'm no expert at crypto. I keep a very small portion of my wealth within it. So then, even if I lost it all tomorrow, it's not going to have too much bigger impact on my portfolio. So yeah, I keep that to about 5%. After that, I invest in some bonds. The reason for that is it just acts as a good hedge against the stock market when it doesn't perform. And I keep the proportion to 10% because I'm a little bit younger. I can be a bit more aggressive in my approach and really look to get into a lot of those growth things in the markets. Now, equally, the second biggest portion of my portfolio is manual trading strategies. Now, this amounts to about 30% of my portfolio, and the strategies that I trade are mostly come from a reversal based strategy and is completely uncorrelated to the algorithm and has even performed well during stock market crashes as well, even when there's heavy momentum. And last of all, the last 5% are for other investments. Now, for me personally, this is like where in Scotland I'll look into investing in some whiskies. But for other people, other common things that invest in is like vintage cars, watches, wines. And this is always a great thing to add into your portfolio because they are completely different. Like it's all dependent on supply and demand. And yeah, it's a very good hedge against the rest of them. So that was a short introduction into how you can apply asset correlation within a strategy, but also within a portfolio. And I hope showing you an example of what my own personal portfolio strategy helps give you a better understanding and will help you create your own. Now, if you do have any questions in relation to this topic, do drop a comment below or contact us through one of our social media accounts. But apart from that, hope you enjoyed the episode. Hope you have a great day. And don't forget to like and subscribe. And we'll see you in the next one.